Podcast Spainsif, plataforma de referencia de la inversión sostenible en España.
Welcome to Podcast Spainsif, the reference platform for the promotion of sustainable investment in Spain. Today, we have the chance to talk to Michael Lewis, Managing Director and Head of ESG Thematic Research at DWS, as part of our podcast series, Sustainable Finance and Transition. Welcome to this podcast, Michael. Thank you so much for being with us today.
Thank you very much for inviting me.
Shall we begin then? What does it mean when we talk about the sustainable finance transition?
Well, there are many megatrends driving the sustainable finance transition, such as clean environmental technologies, but I think one of the most important is going to be public policy. And actually what we've seen over the past year has been a growing number of governments around the world, from Japan, New Zealand, Sweden, and the UK, outlining their ambitions to be net zero carbon emitting countries by 2050 or earlier. And this year, the European Commission set out its own climate law with the aim of being the first climate neutral continent by 2050. So decarbonising economies are going to lead to quite a dramatic change for all of us. It will mean dramatic changes in energy systems, transportation, and food sectors. And it will require a lot more government intervention, and that will come in the form of regulation that punishes these high and inefficient carbon emitters. And it also means more incentives to promote investments in low carbon infrastructure, for example. So what this means for investors is that, along with technology and changing consumer preferences, public policy will present quite substantial risks and opportunities. And I think one of the most really interesting studies in this area has been conducted by the Principles for Responsible Investment under their Inevitable Policy Response Framework. And so the PRI has identified the potential revaluation events that lie ahead by sector, by the potential magnitude, and it's giving us a bit of a clue as to the likely winners and losers in this sustainable finance transition. Typically, not surprisingly, the ones most vulnerable are the utilities, the oil and gas companies, the metals and miners, the ones that have that high carbon nature in their business activities. But also we get to see what are the, there are also investment risks in companies with very high water intensity, such as in the food and beverage sector. And also we're getting understanding that there are really quite substantial risks within the broader agricultural sector as well. There's a huge focus now on biodiversity loss, the focus on cattle, palm oil, soy, timber, the list goes on of all of these commodities and how they're responsible for deforestation. So quite a multitude of risks here, and really trying to understand the sustainable finance transition is really trying to capture not just the spread of all these technologies, but it's also trying to understand that governments, particularly with COVID, the power of governments have gone up massively, and also the public acceptance of stronger government, I think, is also going up. And so all of these present us with a lot of risk and opportunity, and that's what we're really trying to find out and understand when it comes to this sustainable finance transition.
This seems really complex. So why is climate transition one of the most important and overall complex issues from an investment perspective?
Well, you're right. It is very complex because we're not only dealing with technological change in terms of climate mitigation and adaptation, but we're also dealing with public policy, as I've just sort of outlined. And it's really difficult to predict when it comes to their direction and the speed of travel in these sort of technological and public policy areas. And we're also faced with the problem that a lot of companies that we invest in don't disclose the information that we're really trying to understand. What are the climate risks of these companies? So this means that investors are dealing with quite a suboptimal climate data set to understand the risks and opportunities in their portfolios. And so while we have seen enormous improvements in data and the methodologies, and this has been going on for a number of years now, what I think has been almost a big challenge, even more important challenge, is the fact that we have so many methodologies. And you can see here that I think there are about 15 different methodologies to select from if you're trying to push your portfolio and build climate resilience within it. There are all these sort of different ways you can do it, and each one have their focus, each one have their pros and cons. I think the next area that we've been sort of really trying to examine is, this isn't just trying to map out the risks in your portfolio from a market capitalization point of view. It's trying to understand that there is a lot of capex expenditure that's being spent. So what I think is interesting with this chart is that of the world's largest 900 companies, only about 12% of them demonstrate high or excessive levels of climate transition risk when measured by market capitalization. So you might think, well, that's quite low. I can deal with that in my portfolio. But what's more worrying is that the bar on the right is showing what is happening when we examine climate risk from a capital invested perspective and not on market capitalization. And it's this capex which is the problem, because what we're looking at is different companies, obviously in different sectors, can have very different levels of profitability, and that the earnings for the same unit of capital can vary substantially. So just to give you one example, for example, there's much more capital required and invested in an energy company to generate an equivalent level of earnings than for a software company. All the capital for the infrastructure of offshore oil wells and oil drilling, I mean, it's an enormous amount of capex, and it's the functioning of those assets that actually causes the potential damage. So we think you've got to look at the capex, and what we find is that the capex of these very high excessive climate risk companies makes up about 36% of capital expenditure. So it's a really big chunk of where we're going. This is, if that capex continues, we're locking in this high carbon for 20, 30 years. So consequently, we've got to reduce this climate risk over the long term, and we need to reallocate this capital. And as investors, we need to engage very aggressively with those investee companies to reorientate that capital. So it's complex because we're dealing with insufficient data, we're dealing with a lot of methodologies, we're also trying to understand where the climate risk is in the portfolio, and then we've got to build a strategy all around it in terms of our portfolio construction and our engagement as well.
So in this context, how does a company such as DWS, for instance, approach this climate risk, and how does this approach evolved over time? Because I'm assuming there's been an evolution.
There's an enormous evolution, and in fact, we started on our journey of climate risk and identifying climate change as an investment megatrend in 2005. So we've come a long way back in those days, and sadly, it was only really in 2015 that, in a way, public sector officials really realized the problem. We had the Paris Climate Agreement, we had the Sustainable Development Goals signed, we had Mark Carney of the Bank of England telling investors the financial stability risks of carbon. And so for us, what we're doing is, obviously, data is important, the research is important, our engagement is very important, and our investment. So it's those sort of four areas that are critical, as well as our public advocacy. We really want to put pressure on governments as well. So this chart is looking at, it's a little bit complicated, this chart, but bear with me, because what we're trying to show at a portfolio level is where are the risks and where are the opportunities by sector. So I'm looking here at the listed equity universe, and we're measuring climate transition risk on a scale of 0 to 100. So the higher up you are towards 100, the stronger you are to the climate transition. And so naturally, what we see at the bottom end are the areas of the sectors that are really exposed to climate transition risk. Not surprising, I've mentioned it before, it's the energy, the utilities, the materials sectors. And then what we see is those companies that are, and sectors and subsectors in over 50. And so that's the segment of the universe that we sometimes tend to forget about. We always identify the carbon emitters and the problems in the portfolio, but actually there are some really bits of gold and sort of opportunity as to individual companies and subsectors that are actually part of the solution for us. So just to give you one example, you can see in industrials, very wide span of the universe there. We've got marine transportation, airlines at the bottom there, really high risk. But in the same sector, we've got building materials, energy efficiency. We've got these areas that are really part of the solution. So this is why it's interesting not to understand the subtleties of these risks, and that's why for us excluding sectors from a portfolio is a bad idea, because it's suddenly you start to restrict your universe and you start to actually lock out certain parts of the investment universe that are part of the solution. And so obviously the next part of an asset manager's responsibility, having looked at the portfolio construction and the data and the research, is then to say, what are our investments doing? What is our engagement? What is our proxy voting track record? And this slide is sort of showing you the increasing focus we're now seeing on asset managers and their track record. What are they doing when they say they are ESG asset managers? Are they voting in favor of climate resolutions and ESG shareholder resolutions? And this is and this chart I think is really good. Morningstar do it, Ceres do it. That's a US based organization. We've got Share Action in the UK. It's really valuable information that there's more light on the proxy voting track record. And you can see here Morningstar, I picked out Morningstar. This is a very good long time series, 2015 to 2019, who are actually doing what they say and who are not. And you can kind of see here there's some pretty big asset managers that are very way down, low down on the league tables here. And I think this is what you're going to see more and more focus on those asset managers to really up their game and come up to the top of this league table. So I think this is where we're going to see more asset managers trying to establish their credentials on this track record and their voting track record.
Well, this is really interesting, Michael. And now thinking in 2020 and the recent events that we've all been through, what are the short and long run implications of coronavirus pandemic on the sustainable finance transition?
Well, I think it's important to just look at the context of where ESG has come before the pandemic. And what we had seen has been an enormous sea change in the perception of ESG. And this chart, the one on the left, is sort of showing you a survey of institutional investors taken over time. And the question has been, is ESG a negative or a positive impact on financial returns? And you can see here before 2017, pretty much 40, 50, 60% of the population was saying, this is a cost to us. This sacrifices return. It should not be part of our fiduciary duty. What's been interesting since 2017 is how dramatic the change has been. Suddenly, ESG is being viewed financially material. It has a potentially positive impact on return, and it should definitely be part of your fiduciary duty. And why has this happened? What happened in 2017? Well, I think there possibly were a few things. Firstly, we've got more data, we've got more analysis, we've got more live data on fund performance. So that has been very helpful for people to see. But I think what COVID has done in this pandemic is we've seen at the start of this year, in the first 6 months of this year, these ESG indices and funds have been outperforming quite substantially their parent indices. And some of this is a little bit cyclical, some of this is an energy story, but there's an idea that oil prices are repricing. There is a peak in the oil demand curve, and that could really disrupt the future of these assets of these oil companies. And we've seen a number of oil companies over the last month doing write-downs. We had one of the major oil companies doing a $17.5 billion write-down, partly because of COVID, their expectation that their assets are going to be less valuable. So those have been a couple of things that have been going on because of COVID. We've also got, much greater focus on corporates and corporate reputation. And one of the studies we did in 2018 was showing that actually corporate reputation has one of the strongest correlations to financial performance. And I think this is why the social aspect of ESG has really become so much more important because of this pandemic. People are asking, what are companies doing to support their staff, to support their contractors, to support their customers? Are companies providing flexible hours? Are they providing the ability to work from home? What are the safety mechanisms and support mechanisms they're providing? So the pandemic has definitely increased the visibility of performance. It's definitely increased the idea of social aspects, and it's definitely increased the idea of biodiversity loss as a real cost to humanity, a cost to the planet, a cost to growth, and a cost to returns. So we're starting to see ESG encompassing many more factors that have become much more material to investors. And then just finally, maybe just to sort of say what's happening on the government response. And, we are looking around the world at green fiscal stimulus programs. And I mentioned earlier that, maybe the public's acceptance of strong government is going to grow over time. I mean, I've been in this business quite a long time, and free markets and less government was sort of viewed as a good thing, and you shouldn't challenge it. I think the next 20 years is going to be one where governments play an incredibly important role, a much stronger role, and that we're going to see a much bigger arm and force of government to address particularly things like climate change. And the one area I just wanted to focus here is we're really passionate about where is all this fiscal stimulus going? Are we going to see bailouts of high carbon emitting companies like the low cost airlines? I don't think we should. Should we actually be focusing on green jobs? And actually this chart is showing you that actually the best place to spend money to create jobs, and that's all we're talking about at the moment, is to recover our labour markets. It should actually be in the renewable sector, it should be in the real estate sector, and it's just showing you how much money gets spent, how many new jobs do you create. So I think there's going to be a greater perception and acceptance that we've got to focus much more on the green stimulus going forward. And we're still in that preparatory work. We don't know where it's all going, but that's one of the areas that I think asset managers have a role to play, and asset owners, in being a very strong advocates for green stimulus, for ESG, sustainable finance. So we need to, as a community, an investor community, continue to put pressure on governments to hopefully follow our recommendations and provide a much stronger green element to the recovery programs that are being launched at the moment.
Michael, thank you so much for joining this podcast series and just transition from a sustainable finance point of view. It's been a pleasure having you in-depth view on this topic from DWS perspective. Also for the conceptual approach and its complexity, for the challenges with respect to data and methodologies, and the importance of research and engagement strategies, as well as this implication on all of this. So thank you, Michael. And as for the audience, thank you for listening. We'll be meeting again in the following podcast series from Spainsif.
Podcast Spainsif, plataforma de referencia de la inversión sostenible en España.